Hi, and welcome back again to Tim Bigham's Big Time Options, Edges and Hedges, taking a look at another vol capture trade on these AI names that finally had a little pushback by the end of today. This one is Qualcomm. We took a look at Marvell the other day with a defined risk iron condor. Here it is a sell straddle going out to September, and how the rally in Qualcomm stock actually caused the straddle, which got less, out of the money, if you will, closer to the ideal price point, to expand because of that jump in IV. So take advantage of selling the highest IV ever in Qualcomm by far with a sell straddle. So as we always like to do, we do a fusion approach, take a look at the fundamental, technical, and most importantly, IV analysis. So let's jump in and take a look, shall we? First of all, here's the trade. I went back to May the 6th, right, with the stock trading about 186 and a half, right? The September 250 straddle where the puts were well in the money, the calls well out of the money, right? Obviously a bullish trade if you did it right, selling a deep in the money put, bullish, right? And then hedging by selling a way out of the money call. You can see the IV back then trading just under about, 51 or so. You were selling a 78 delta and a 22 delta, so negative 78, 22. You'd certainly be net long deltas, right? And yet theta time decay about 6 cents a day on both the calls and the puts. So back then that sell straddle trading at 75 bucks. Fast forward to yesterday's close, right? You see Qualcomm closed at 217.77, right? But that sell straddle with the stock moving towards the ideal price, right? If you're selling a straddle, you want it to move towards the strike price of 250 in this case, right? So the stock did move, right, from 186.55 to 217.77. So you expect the straddle to get cheaper, right? You also had about a month's time pass, right? So time decay hits up. So from a theta perspective, right, time decay, you'd expect the straddle to get cheaper. But lo and behold, because of the huge jump in implied volatility on these names in the AI space, and Qualcomm certainly being one of them in a big way, that sell straddle actually increased by about $5 because the IV, which back then, right, was trading right around the 50 level, right, is now over the 80 level. So we're looking at a huge uptick in IV. So kind of doing a side by side on May 6th, right, the stock was what, 186.55. That 250 straddle, right, puts are deep in the money. The 250 put, calls way out of the money, closed at about 75 bucks. It was out of the money by about, if you will, 63 and a half bucks. In the money on the put side, right, out of the money on the call side. I just used that term because you want it to close right at the 250 level. Days to expiration 135, right? You would have been 56 deltas net long selling that straddle back then, right? Selling that deep in the money put and that way out of the money call, right? So certainly a bullish trade, and you'd pick up about 12 cents a day on time decay. The IV back then just over 50. Fast forward to yesterday's close, right? You can see the stock closed at 217.77. Yet that 250 straddle actually increased about $5, as you can see here, right? Even though it is less, if you will, in the money on the put side, right? Calls are still out of the money. Puts in the money by only by about 32 points instead of 63 points. So you'd expect that straddle to get cheaper, right? Days to expiration, you basically had a month's time pass. Time decay, a big benefit for selling options, right? But we also see the delta now. You're still bullish, not as bullish, right? Because the call is actually less out of the money, the put less in the money, right? And with the uptick in IV, right, kind of skews the deltas a little in the call direction because of the upward drift. But you'd still be net bullish, right? So over that time frame, you'd been about 30 deltas net long with the stock moving up about 30 points. So your delta gain on the trade, right, from the stock movement, right, you'd expect to make a little bit over $9. You have a bullish trade that still remains bullish, right, and the stock went up very nicely. Time decay or theta, right? Now the theta is at 36, right? Because of that jump in IV, you were seeing 19 and 17. We had a positive theta, obviously, by selling it back then about 12. So you'd expect over the course of that, the theta to be somewhere around the 20, level, right? So you're picking up about 20 cents a day, right? You had about 33 days pass. So your theta gain, you'd expect to be a little bit less than $8. Delta gain a little bit more, $9. Combine the two, you'd expect that straddle that was trading at 75 to drop by about 17 points, right? Somewhere better. Trading's probably around $58. Lo and behold, it's trading higher, right? Why? Because you saw this huge uptick in implied volatility of over 50%, all because of the rush, especially on the call side for these AI-based stock options. So this sets up ideally for that vol capture trade, as we said, capturing that IV pump. Taking a look at the IV, here's the 120-day IV. You can see the stock just ripping higher, and the IV also ripping higher, which is usually counterintuitive, right? But just huge demand for the calls, right? We're finally seeing it soften a little bit here lately, right? IV not at 100% anymore, but still at 90, still very high. Here you can see kind of a look back over the past 20 days or so. You can see IV has just absolutely ripped higher. It was under 70 not too long ago, now over 80, right? You can see the September options that we chose finally showing a little bit of softness, but still very richly priced at the mid 70 level. Here is a 5-year chart of basically the 120-day 50 delta call. You can see the implied volatility at by far the highest level we have ever seen in that time frame, that huge uptick as the AI mania takes it higher. Here's a shorter term look, 6-month chart of both the calls and the puts, 50 delta call and put. You can see that absolute just gonzo move higher and finally starting to soften. We always like to see a little bit of weakness before we really jump in. Fundamentals, certainly Qualcomm has had some decent earnings, right? But you see valuation still at the higher end, right? Price to earnings, right? Pushing towards that 25 level again, was briefly over 30 and then got hit hard, right? Price to sales, same sort of idea here on a 1-year basis, right? Instead of the 5-year on the PE, you can see price to sales, which hit 6, still over 5 here. So valuations, right, are very rich. Interest rates aren't heading lower, right? So supporting these multiples might be difficult. That will probably cap off the upside. The analysts are expecting Qualcomm stock, if you will, to be about a $182 item, if you will. So kind of supports our sell straddle, right, where we're selling that 250 straddle for $80, right? So 170 is our downside break even, right? 330 is our upside break even. Taking a look at the chart, kind of put that line on the chart. Here's that kind of 170 level, which is kind of support to post earnings, right? And earnings were absolutely a very nice beat, right, on both the top and bottom line, no question, right? But now the stock running into a little trouble. So 170, here's our kind of downside break even. 330 is literally off the chart. 330 does not exist on this chart at least, right? So you have plenty of cushion. That's the nice thing about that huge jump in implied volatility, right? You can get further out of the money, right, and get the same net credit, or get a bigger net credit. It'd be the same amount out of the money, or play in between, as we usually like to do, get more credit and a bigger cushion. So it sets up ideally, I think, for this sell straddle trade, and that's exactly what we did. Taking a look at the trade, here it was, we put it on this morning, right, selling the September 250 straddle for $80 net credit. Stock was at 214.57 at the time, able to sell about a 78 IV, 8 deltas net long, so we're still bullish on the trade, but this is absolutely more of a vol capture trade, looking for that IV to drop back down. We're not waiting for it to head back down anywhere down here, but if we get into the 60s on the IV, we will certainly be looking to take that trade off for a very nice gain, right? Margin requirement, a little over 4 grand for each spread if you're approved for selling naked options. So that's what kind of money will be tied up. You can use 5,000 as kind of a cushion in there. So 5 grand, and hopefully we can make a grand or so on the trade, a quick little 20% gain, right? Take the trade off and move on. So identifies how we go about thinking about trades here at big time options, how we take advantage of that implied volatility on a stock that had gotten overbought, but finally showing some weakness here, right? That had gotten overvalued, right? Fundamentals pushing, right, towards the highest we have seen in a very long time, but beginning to soften a little bit, right? And just as importantly, or probably most importantly, right, from an IV perspective, looking to sell this huge spike in IV, right? The highest level by far we've ever seen, and just looking for it to revert back. So we'll see how it goes. And again, position sizing is always important because, as we know, trading is all about probability, not certainty. So position size accordingly. Make sure you get out of the trade, at a point that you're comfortable with taking it off for the either gain or loss, right? Especially on the loss side, right? If you don't know where to get out, you shouldn't be getting into the trade. So we'll see how this goes. We'll give you an update shortly. And as always, here's the good trading. Take care.